Welcome to the Valmika Property Investing Podcast, where I, your host, share the key to success in the Australian property investing market. I'm the founder of Valmika Buyers Agency. You can find us at valmikaproperty.com. The contents of this podcast are the personal opinion of your host and are intended for entertainment purposes only. Any financial advice must be obtained from your trusted financial advisor or a qualified professional. On this episode, I'm going to be speaking about an instrument that is significant in building wealth in property. And in fact, it's what makes property such an outstanding investment class and what generates significant returns. And it's all about utilizing debt or your mortgages, so to speak, effectively. The whole secret about private equity, when you look at the high end of the streets in fund managers and private equity firms that invest capital on behalf of investors and how they generate significant returns, it's twofold. Number one, investing in an asset that grows. And number two, using debt effectively. Think of debt as having a very cheap equity partner who's only requiring a relatively low rate of return when compared to your equity investment. So the whole trick in property investment is making sure that the asset returns at a higher yield or a higher investment return than the cost of your debt. That is what we call delta. The bigger your delta, the greater your acceleration in your wealth generation. The tips I'm going to take you through in this episode is going to show you how Wall Street uses debt effectively to generate exceptional returns. So the title of this episode is Tips on How to Accelerate Wealth Through Effective Mortgage Management. The first topic I'm going to speak about on this is managing offset accounts. So for those that are not familiar with offset accounts, this is an account that you can set up with your bank, so your financier, and it's a separate account to your mortgage facility. But how it works is it offsets, as the name suggests, against your debt facility when it comes to calculating interest. So as an example, if you have a $500,000 debt facility, and you've got $100,000 sitting in your offset account, when interest is calculated on a daily basis, it's calculated on the difference between the two. So 500,000 less 100. So interest is calculated at 100 on $400,000 instead of $500,000. So effectively, on a daily basis, you're saving on interest to the tune of that balance in your offset account. I've seen people with home loans make mistakes around this. So there's the mindset of saving for another day, which is a good mindset. However, instead of putting into an offset account, they'll put it into a fixed rate facility that they earn interest on. But the problem with that is that the interest that you earn in those bank accounts are significantly lower than the cost of your debt. So the secret to using offset accounts, if you can't allocate the capital into another asset, so to speak, that returns higher than the cost of your debt. So if the cost of your debt is 6.25%, where it is currently at the time of this podcast, if you're putting it into a savings account that's returning, say, 3% or 2%, you are effectively losing the difference between the cost of your debt and what you're earning in the interest facility. So in this case, you're paying away 6.25% per year, but you're only receiving 3% in the savings account. So you are losing to the tune of 3.25% for every cent that is sitting in that savings account. So it's worthwhile putting everything into the offset account. There's other tips around that. So if you get paid your salary, make sure it gets paid into the offset account. Use the offset account as your main transactional bank account, because for every cent that goes in there, you are saving on interest. Interest is calculated daily on your debt facility and it's offset daily against your offset account. So for every bit of capital that is sitting in your offset account, you are saving on interest. And this can make a significant difference to your bottom line. And this is a very clever and effective way to generate a lot more wealth off your property through managing the debt this way. The trick about offset accounts is it does not lower your amount of payments every month. So let's say, for example, you've got a $500,000 loan and you've got $100,000 sitting in your offset account. The repayment schedule over 30 years on a $500,000 loan is just over $3,000 a month. However, placing $100,000 in your offset account doesn't change the fact that you still got to pay $3,000 a month. It just means that you're paying less on interest. So of that $3,000, more of it is going towards your bottom line, the capital repayments, instead of the interest. So you're saving on the interest, but you're paying down the loan a lot quicker. So if you are running into a cash flow management problem, the effective way to do it is, and you want to say lower the monthly commitment from $3,000 down. Let's take the same example. What you can do is you can take the $100,000 from the offset account and pay it directly into your mortgage facility, your debt facility. But before doing this, I would recommend speaking to your bank and asking them to make sure that it is a redraw facility. So any extra capital that you put into that redraw facility, you can redraw it at a later stage. But what this will do is it'll lower the amount from $500,000 to $400,000 in the debt facility when you place it into that debt facility. So now the repayment schedule drops from $3,000 to say $2,450. So you have less commitments every month. The other trick around doing it this way as well is that, let's say, for example, your offset facility doesn't have a positive balance anymore. You run into some unforeseen costs that month and you don't have a positive balance in your offset account. So when the bank comes to take the $2,450 payment and there's nothing in there, what the bank will do is they will just lower the redraw facility amount. So they'll lower it by the tune of $100,000 less than $2,450. So this is something that you can set up with your bank as well. This is all a clever way of managing your cash flow in a time when there's high interest rates. So it's being in property is all about staying in the game, and this will allow you to stay in the game. So that is another trick around how to manage your debt facility. The third one I like to speak about is the timing on your mortgage rates. So this is the when to switch from floating to fixed. And it's all about understanding interest rate cycles. Often the mistake that people make when they're looking at whether to fix or not is they're looking at where interest rates are currently. And that is actually a mistake. And the reason being is that interest rates are a market that is actively traded. It's in the fixed income derivative market. So traders in this space are predicting where rates will be in the future based on current economic conditions. So for example, if we go back to when rates were at the lowest and we were at the turning point going into interest rate hikes, people were then looking to say, okay, maybe we should look at fixing interest rates now. However, if they had done it a couple of months, a couple of weeks earlier, they would have got a more favorable fixed rate. And the reason being is that the whole market was pricing interest rate hikes, and they priced a significant amount of those interest rate hikes already into the interest rate curve. So the way the banks will price your fixed rates will be a spread above the interest rate curve. Now, the interest rate curve predicts interest rates on a quarterly basis all the way out to say 30 years. So they will predict where interest rates will be under current economic situations, where they'll be in the future. So it's important to keep that in mind. It's always forward looking. So for example, like now, you will see that the traders are starting to price in interest rate cuts towards the end of next year in Australia. So rates are starting to come down already. So it's worthwhile keeping an eye on it, because when the RBA does start to cut interest rates, the market will predict on how deep those interest rate cuts will be. And that will give you opportunity into maybe fixing interest rates at a low level before the interest rate cuts even start with the RBA. So it's something worthwhile to keep in mind. How do you look at this? It's worthwhile asking your bank to send you the interest rate swaps. And keep in mind that traditionally the banks would price in around 200 basis points over those interest rate swap levels as a rough guide. So you can gauge on where the market's predicting those prices just by looking at that. And we do that often for our clients. We like to advise on where we think the interest rate cycle will be moving, how much of an interest rate cutting cycle has been predicted in, or a interest rate hiking cycle is predicted in. And based on that, together with economic prints like wage pressures in the market, inflation pressures in the market, retail sales, for example, how strong the economy is, we like to gauge how strong it will be, whether the RBA will move or not, based on those economic indicators. And from that, we determine the interest rate cycle that we're sitting in. And then from that, you can best gauge on whether to fix or not. It is not a perfect science. There's obviously a bit more to it, but on average, we get the calls right within 25 to 50 basis points of the lows and the highs of the interest rate hiking cycle. So to conclude, it's interest rates and mortgages are a very important dynamic in your property journey. If you use them effectively, you can generate significant returns in your property investments through the power of gearing. Gearing is good debt, and it's exceptionally great wealth generation tool when you manage it properly. Moving on to the auction clearance rates for the weekend of the 22nd of October. New South Wales had a good clearance this weekend, clearing at 71.8%, with Sydney clearing at a strong 74%. Queensland clearing at 57%, with Brisbane at 66%, a little bit up from last week. Victoria clearing at 67.8%, with Melbourne at 68.6%. Western Australia, the numbers are a bit volatile there, so it's hard to gauge from the auction clearance numbers. So it's always worthwhile to point it out. However, the stats that we've got from CoreLogic are 41.7% clearance for the state of Western Australia, with Perth clearing at 44.4%. And still the strongest state, as it has been for quite a while now, is South Australia, clearing at 83.2%, with Adelaide clearing at 83.8%. I hope you enjoyed this episode and you found it valuable. We will see you in the next one. Thank you for joining me on this episode of the Valmika Property Investing Podcast. I hope you found our discussion insightful and empowering. If you are interested in finding out more about our services at Valmika Buyers Agency, visit our website at valmikaproperty.com. There you'll discover how we can assist you in making informed decisions and achieving your property goals. See you on the next episode.